Hi, we're live. Thank you for your patience, everybody. Welcome to DOT's inaugural Outlook panel discussion, which is something we hope to hold every year going forward. For viewers new to DOT, my name is Luke Dixon. I'm co-founder and head of investments here at DOT Investing. In addition to my responsibilities for researching and onboarding great private market funds to our platform, I also write our periodic dispatch newsletter, some other thought pieces, and I'm the host of our DOTcast series of manager interviews. I'm delighted to be joined today by two key advisors to DOT Investing, Lord Nat Wei, who by his title would reveal that he's a member of the House of Lords here in the UK. So I think we'll bring some interesting and differentiated perspective to our discussions. And Gabriella Kindert, who's been advising us for a couple of years now on the growth of the business and also helps me in relation to private credit markets. She and Nat and Lance as well will introduce themselves in due course, I should say. Special guest today who went unannounced when we first publicized this Outlook webinar. Lance is head of U.S. private equity secondaries from Unigestion, who we are proud to partner with at DOT. He will also be introducing himself in due course. I want to set the stage for this discussion, which is really a discussion around macroeconomics, microeconomics to a degree, but most importantly about investment strategies and where to consider putting your money in 2023, given probably more meaningful macroeconomic uncertainty and geopolitical uncertainty than many of us and our listeners have been faced with, probably excluding last year, but in our lifetimes, if certainly not in the last 20 years. And so lots and lots to think about, certainly a lot of reticence in the feedback that we're getting from our investors. I think there's some green shoots and light at the end of the tunnel, if you will. And also we'll touch on how private market vintages, crisis era vintages, happen to be among the most profitable historically. So notwithstanding perhaps some nervousness about this market, it is probably one of the better times to consider investing. When others are scared, it's not a bad time to consider putting money to work. So let me contextualize this discussion a little bit, and I'm going to refer a little bit to the paper I wrote a couple of weeks ago, which provide a little bit of background on performance last year. I'm sure every one of our listeners looking at their portfolio or reading the news knows that 2022 was among the worst investment years in recent memory, from major economic indexes being down anywhere from minus 30% in the case of the NASDAQ to minus 10% in other developed markets, to fixed income, down probably one of the worst years on record for fixed income, particularly amongst longer duration fixed income, down anywhere from 10 to 15+%. The longer the duration of those instruments, the worse the performance tended to be. And as a consequence, balanced funds, which probably characterize the investment portfolios of most average people, there was nowhere to hide, and performance was down 15 to 20%. So where would you put your money? Where could you have put your money in 2022 to protect it from these sorts of adverse market moves and volatility? We've definitely got ideas here at DOT. We are big advocates of private market investing, not just because instruments are valued differently, but because you can access differentiated sources of return that are typically are a premium to what you can get in listed markets. So we are big advocates for that. In terms of themes that we saw driving markets last year, I think there's different ones, but I think the major ones for me anyway relate to inflation, interest rates, and war. Clearly, inflation looks a bit different and feels a little bit different depending on where you are in the world. Lance joins us from New York City. In the US, it looks like perhaps inflation may have peaked in June of last year and has been slowly coming under control. I can tell you from my perspective here in London, and Nat's probably feeling this as well, it doesn't really feel like inflation has peaked. It seems that every time I pop into the grocery store to stock up, everything's just a little bit more expensive. And that seems to be a recurring theme week after week after week. Yeah, there's been a bit of a drop off in energy prices. Mercifully, we've had a very mild winter in continental Europe, which has eased pressure on natural gas and oil prices, which is great. Conversely, we've had an unseasonably cold winter in the UK. So again, it doesn't feel much like the pressure on our energy prices is changing here in the UK. We've had a very different experience this winter than our friends and neighbors to the south on the continent. As a result, interest rates in response to inflation are different. We had the US Fed raise interest rates by 25 basis points yesterday, which was below what was forecasted only a few months ago. And that's because we've had better than expected or lower than expected inflation numbers. So it's meant that the US has been able to ease off a little bit on raising interest rates to combat that inflation. But we have a different experience here in the UK. In Europe, we are probably further away from peak inflation, or we certainly didn't peak in terms of inflation as early as the US did. And as a result, the interest rate cycle is a little bit different, or the timing of it is likely to be different. We're going to see what's going to happen with European and UK rates today. They're also expected to continue to increase rates and see high inflation and rising interest rates, puts pressure on markets. We've got other things to consider. Obviously, the war. We talked about inflation and interest rates about this time last year. What we didn't predict was a war to break out in Europe. Notwithstanding the tragedy around that, which is a whole other discussion. Clearly, that's a big macroeconomic geopolitical variable, which is very difficult to predict. I think at this point, the markets are not ignoring it, but they've become accustomed to the headlines around the war. And probably the only thing that is likely to impact markets from the war's perspective is either a negotiated peace, which seems extremely unlikely, or an escalation, which is really unfathomable and not really not something to consider necessarily for this discussion. It is an extreme outlier. Let's hope it doesn't happen. But it's out there and it can't be ignored. It may be easier for Lance and his countrymen in the U.S. to ignore it because it's not on their doorstep. Here in Europe, in particular, where Gabriella is, and for us in London, it's kind of more present and ever present in our face, and we think about it more and more every day. So that's to set the context. Difficult year in 2022. A lot of the same drivers likely to impact upon markets and investment decision making in 2023. Those are my thoughts. What I'd really like to do now is, starting with Nat, get his thoughts. First, Nat, if you will, please give us a brief introduction to who you are, what you do, and then give us your thoughts on what is one or two key themes that are likely to impact markets in 2023. And then we'll move in turn to Gabriella and to Lance. Nat, over to you.
Great. It's good to speak with you all. I am a legislator in the House of Lords, but also sit on various advisory boards, including in venture capital and technology, having had that background first at McKinsey and then in sort of tech generally. And I've got a particular interest in impact as well. I suppose the main sort of from where I sit, the main sort of impact on this year is going to be geopolitics and sort of we're all working through right now the end game for Ukraine. The most likely scenario is some kind of protracted conflict. I think it is sort of in the West's interest to erode kind of Russia's capability over a kind of long period of time. You saw the escalation with the tanks being shipped over. And, everything we hear from Putin is a real determination. So I agree that the markets have generally priced in this scenario. The question will be what Putin does in terms of, for example, diesel. He may want to play the card to squeeze diesel in Europe, which will affect a lot of the kind of people who drive those cars there, mainly from lower incomes. So there is a bit of risk on that side. China is opening up, so I'm a bit more bullish on that side. Not sure that they really want to go for Taiwan, given the state that the economy is in there. So I was just recently in Hong Kong, seeing relatives after many years with lockdown, and there was definitely a change in the atmosphere as the lockdown started lifting. So I think this is a year really to keep an eye on geopolitics. Inflation will be high. So the kind of investments I think that make sense are those that help people and companies reduce costs, improve productivity. So generative AI, it's not surprising that this may be the year for a lot of that technology to move forwards, because it's about how do we use the workforce more productively. And I think a broader theme coming out of that, I was around during the dot-com era 20 years ago and afterwards. And of course, we all remember and talk about how, the Amazons of the world were created around that time. So out of this period, it'd be interesting to see which companies really survive and thrive. And then in the medium term, I'm very interested in investments that look at climate change. That remains the long-term issue. And so any company that can deal with both short-term cost of living and have a climate change benefit, obviously is very attractive. But one thing I think that's something that's a bit hard to predict, that I'll just leave you with, is the demographic shift that is now underway. So even in China, we lost, I think, something like 800,000 people net in the population. We're coming to that peak, and I think that has an impact even on inflation. So for those who think we're in a long-term inflation environment, I would just be careful, because obviously as you have fewer families, they buy less, and that ultimately will flow through into a more deflationary environment. But in the short term, especially with all the Chinese tourists coming out, there's the risks this year are probably more on the upside on inflation. But again, I wouldn't price in a perpetual inflationary environment. I just think the long term, and therefore with the demographics aging, healthcare, life sciences becomes a long-term bet that I think is worth making, because we're all getting older and we all want to be healthy.
Excellent. Thank you, Nat. Appreciate that. We will come on to some of those topics around the investment side in due course. Gabriella, can we get your thoughts on what you think are the key economic drivers for investment decision-making in 2023?
Thanks, Luc, for the introduction, and thanks a lot for inviting me. So I'm based in Europe. Currently, I'm calling in from Budapest, but most of my time I'm spending in Amsterdam. And in the last 25 years, I have been working in the investment management industry and banking sector, BNP Paribas and then IP. So I have a very European perspective on things, based on my background, and very much focused on private markets, private credit. So where are we today? So we have been in a time when we haven't priced in our resources properly in the last 20 years. We haven't priced in time value of money. We haven't priced in cost of debt. We haven't priced in cost for the planet, cost for the society. So we have systematically for 2 decades not priced risks properly. And I think that time is totally over. So what we are having now is a situation when we are repricing risks in a proper normal interest rate environment, and we try to price in what would be the cost for the planet, what would be the cost for the society. And what does it mean for companies? That enterprise values will look very different in 10 years' time, 5 years' time, 15 years' time. So we have to be very mindful of that. That's the first theme I'm seeing. The second theme is that, though it's not really the title of the panel, when we have to predict what's happening in 2023, I think we need to accept that we cannot predict. We need to accept that we cannot predict. And I mean, if you look at the brightest minds in the World Economic Forum who produced their predictions in January, just please do me a favor, they constantly missed. They missed the COVID, they missed the war, they missed most of the things. They haven't mentioned the top 10 risks. Just think about 14 months ago, we were totally locked down. I was in Amsterdam. We were locked down because of Omicron. False alarm. But we had a lot bigger crisis, a war. It was written already on the wall. We missed it. We missed the risk of Russia. I grew up in Hungary. I'm Hungarian. We became totally dependent on energy supply from Russia. We missed it. So if you cannot predict, you have to be very humble where you put your money in. And I think if you cannot predict, you diversify. And I think we are also getting to an age when you diversify your investments, diversify your home, diversify your passports, diversify almost everything. Because to be honest, I don't know. I'm living in the Netherlands. I don't know where my house will be underwater. I honestly don't know. So we live in a time of uncertainty in terms of war, disaster, heat waves, so on and so on. We need to accept that. Energy crisis we mentioned, global warmings clearly mentioned. I also see a divergence between different regions. And I think some of the regions are more impacted than others. We need to be mindful about this. And in some of your needs, basic needs, you rely on regions like the US. So how you diversify and how you make sure that you are less dependent on basically rising cost of currencies. I think overall the schemes I see from the large institutional investors is the need for liquidity. So I do feel that there will be many opportunities in terms of picking up assets because people are trying to exit from certain assets, especially in private markets. So excellent time to pick up certain assets. And regarding my points on repricing risks, I do feel that we will experience many defaults from companies, consumers. So we will see increasing defaults, and liquidity will be the key for many people. So I can speak a lot more about this, but I think these are the themes I observe, and I think these are some major structural changes. And I am actually quite optimistic that the investment we need to have in transformational climate-related activities will be so huge that we will get out of a recession. The need for investments is 6 to 9 trillion yearly. Our entire banking sector is 30 trillion. So massive need for investments to tackle the climate crisis.
Excellent. Thank you, Gabriella. Some very interesting insights there. The idea that what we're talking about, key themes and drivers, are always hard to predict. And the fact that we often misdiagnose what might happen, we get these predictions wrong. It seems fairly obvious that should lead people to diversify, but often it doesn't. And I think for us at DOT, that underpins essentially why we're in business. We think there's a vast array of investment opportunities that exist in private markets that, to an increasing degree, don't exist in public markets, and these investments behave differently, that they are really useful, if not critically important, diversifiers in investment portfolios that can now be accessed by a much broader selection of the investment universe, meaning in our case, qualified individual investors. And as you mentioned, a lot of institutions now, having already heavily invested in private markets, are now a bit challenged in terms of what they can deploy into private markets in 2023, because their public market investments have sold off so meaningfully. I'm quite certain this is a topic that Lance is going to touch on shortly, so I don't want to steal his thunder too much. Lance, over to you for a brief self-introduction and your thoughts on the economic environment, key themes and risks that we might be faced with from an economic perspective before we then dive deeper onto the investment side.
Yeah, thanks, Luke. And I'm very happy to be here and to be joined by such an esteemed panel. So as Luke mentioned, my name is Lance Zhou. I am a senior vice president and head of U.S. private equity secondaries here at Unigestion. I've been working in the PE industry now for over 15 years. First got my start actually as a fund accountant, administering a few vehicles for the first 4 years of my career in PE before transitioning to the investment side, and have been doing that for more than a decade now, with more than 8 years or so really focused on the secondaries market. At Unigestion, we are a global investment management firm with about 20 billion in assets under management. Private equity makes up more than half of that, which is the group that I'm part of. We really pride ourselves as specialists in this market in helping our investors construct global low and middle market portfolios through primary fund commitments, direct investments, and then certainly leveraging those global partnerships and relationships for our secondary program. I would say I really only have, came in today with sort of one key theme that I've identified, and that theme is really surrounds selectivity. I'm going to borrow a quote here from the great Warren Buffett, who says, when others, that certainly you want to be greedy when others are fearful. And I just think that now is such a great time to be an investor in today's market. I'm also going to want to echo the thoughts that Luke and the Dot investing team noted in their recent paper that was summarized by Luke before we started the panel today, which I felt really encapsulates my thoughts on what is to come and what is to be expected. Against a backdrop of a tougher fundraising climate in the private markets that's been aggravated by a slower M&A and certainly a tight IPO environment, I expect no real shortage of secondary opportunities, especially in private equity this year. Those opportunities can come from other limited partners who are really seeking to either reduce their denominator effect or to free up capital so that they can continue to deploy money to their best managers. It can also come from general partners, GPs as we like to call it, who are seeking liquidity for their own LPs, obtain additional dry powder to fund expansion opportunities for the crown jewel assets in lieu of a potentially expedited fundraise, or to recapitalize their investor base through a tender process per se, whereby liquidity constrained or very tired LPs can cash in their PE fund stakes, and then those same PPs can bring on a fresh set of investors for their books. Nonetheless, as astute investors, I would strongly urge that we continue to maintain our high bar, and hence the selectivity that is my sort of key theme coming to the year when it comes to such a ripe environment for cherry picking the best deals. Last year in the secondary market in private equity, we saw secondary transaction volume decline by about 20% from 130 billion in 2021 to about 110 billion in 2022. What's not said much is that 130 billion volume in 2021 was actually the record. And the second highest record in history was actually last year. Even though, as my panelists already mentioned, we had headwinds from inflation. We saw higher interest rates. We saw volatility in the public market that continues today, notably in the tech sector, which cascades down into the venture capital market. The Ukraine-Russia war that is still unfortunately ongoing today. And we still continue to live in a COVID environment that until about 2 months ago, we had the second biggest country in the world, China, finally lifting its untenable zero COVID policy. So, against all that backdrop, last year was still a great time. And that's what gives me confidence heading to this year. So suffice to say, I'm very excited about the investment climate that we're about to enter into this year.
Thanks, Lance. That's fantastic. We're going to touch, I think, more on the secondary opportunity set shortly. In terms of the economic drivers, Nat, I just wanted your thoughts on deflation were interesting. I wouldn't say I'm a student of demographics, but a friend of mine is big into demographics. So I've been hearing for the past 15 years about the impacts of aging populations, and see, those trends haven't changed. The working populations in a lot of countries are shrinking, and that's exacerbating labor shortages, which even in times of recession, one of the things that certainly held up in the US very well, but also elsewhere, is we have tight labor markets despite perhaps slipping into recession, which seems a little unusual. Demographics is a very long-term theme, but nonetheless must be having an impact on the size of the labor force, and this isn't going away. It'd be interesting to see how quickly that this issue of demographic shifts, shrinking working age populations, impacts on inflation. I'd be amazed if it was a near-term problem. Deflation in many respects is even scarier than inflation. I think we've historically found it very difficult to manage deflationary environments. Looking at Japan as an example of that, still struggling after about 25 years or so since their markets peaked in many ways. So I really hope that we don't find ourselves in that situation now, but it's interesting to hear your perspective on that. Thank you. I do want to shift our discussion away from macroeconomics to more on the investment side. Lance, your thoughts on the secondaries. We're going to dig a bit deeper into that momentarily, and certainly as well on the credit side, Gabriella. Lots to talk about there. Now, you mentioned some interesting things about productivity, and I'd love to dig a little bit deeper on that. It certainly makes a lot of sense where companies are struggling for growth, where their profitability is being hurt by rising interest rates, perhaps by a slowdown in consumer demand. How do they maintain profitability, which helps keep, if you're a listed company, helps keep your stock price up? In the case of private companies, helps keep your valuation high. How do you continue to grow? You're very close to a lot of, I think, innovations in the tech sector. You mentioned your background in venture. Just can we dig a little bit deeper into the AI themes and where you think some of the better investment opportunities lie on the tech side? And are they largely venture based, or are we likely to see more opportunities in the growthier and the buyout side of private equity, if you've got thoughts on that?
Yeah, I think what I would say that because of the demographics and the kind of shift from a more stable kind of globalization kind of based world to a much more post Bretton Woods environment. I've seen this for the last sort of 5+ years, maybe 10 years. We're kind of in a phase transition, really. That's how I describe it. So a lot of I think the traditional predictions, is it going to be a down year or an up year? Well, some things will be going up and some things will be going down. Right now in the UK, in our micro environment, we have 500,000 people over 50 who since COVID have decided not to work. They've either taken early retirement or they're just taking a break. Maybe they want to do part-time. So that is causing, I think that's part of what's causing our inflation in addition to energy prices. And we're seeing, certain jobs and certain industries having huge labor shortages, whether high skilled or low skilled. I think though, with the technology that's coming through, we are now starting to see a bit of a push, even on the bigger companies, to finally, grapple with the productivity issue. It's been too easy, certainly in this country, to bring in people from abroad and just throw low skilled workers at a problem, right? You even see this in China because they historically so many people. Now you actually have to think through as a corporate, how am I going to get this? Both manage the fact that I don't have as many workers anymore, full stop. Work out which ones I need to continue to do what I do, and then work out the systems and processes, including with AI, to improve that. I was yesterday at the Old Bailey, which is our top criminal court, and I asked the judges I was having lunch with, do you think we should use AI? And I thought, because they're of a certain age, I thought they'd say no, but actually they're very open to it, because what they were saying, and you see this in many industries, there's too much data in crime, in court cases. They can't find the relevant information from the noise. And in terms of hours lost, that's just huge numbers, right? So even they're open to the idea. But the question is it going to be ethical? How do you keep the humans involved in such a way that in the court cases, the defendants need to see that they got a fair trial, that it wasn't just done by a computer. So I think it'd be interesting this coming year and next year to focus on those tech businesses, especially in deep tech, that are able to drive massive increases in productivity, but don't bring lawsuits, because there's an element of human ethics and control still in the process. And I think certainly in that space, we're starting to see, I was talking to some Cambridge investors in this space, they're starting to see some very sophisticated technology come through, which makes the older kind of learning engines much more sort of primitive in comparison. And really a big solution for a lot of our economies, and I think this is, to me, an opportunity for investing, is how do you work with the workers you've got left and make their jobs better and create more value and better salaries for them by bringing in automation, not to always replace them, but by shifting that. And I think in Silicon Valley, I see they've got hiring freezes, they're bringing in the bots. I don't see that happening, and that's going to sting them in the tail, because their pipeline is going to suffer for talent in the next kind of 3 to 5 years as a result.
Very,
I'd love
very
to expand on Nat's point, if you allow me to, Luke.
Please, absolutely. No, that's what we're here for. engage in debate.
It's interesting, the evolution that we see here in the venture market, especially from my perch in the US. I think in the last sort of 2 years, from 2020 to 2022, there's been a lot of talks in the venture market, pushed forth by some big behemoths like Andreessen Horowitz on this Web 3.0 concept, which they likened it to, creating the next wave of crypto, NFTs, and the metaverse, which, quite frankly, as we have seen, just hasn't quite panned out, which has unfortunately led to a lot of layoffs, not the least of which was felt by Meta, by Zuckerberg's firm most recently, laying off 11% of their workforce. The biggest sort of theme that we saw coming into venture this year is the explosion of ChatGPT, which seemingly came out of nowhere, which hasn't been the case, right? Like, it's a company that's been in the works, mostly stealthily. But if you're an insider in Silicon Valley, it's a company that's known to a lot of people. So until Sam Altman and his crew at OpenAI really debuted it to the public and offered it as the beta, I don't think anyone truly understood the power of such a platform. But if you're in VC, and if you're in the growth side of private equity, an area that I sort of been living at for the last 15 years, that's something that we expect to see. So a massive theme, in addition to what Nat mentioned about companies looking to increase their productivity, is automation, the continued automation of our jobs that hopefully makes our jobs easier, not necessarily take our jobs away. I think we're going to continue to see digitization as a big theme, and I don't think AI or ML is going to go away anytime soon.
I don't know what your thoughts might be on this, Lance, because of your perch, your world in the private market sphere, but certainly something that we've been reading a lot about here at DOT, and underpins, one of our key theses around the provision of private market funds, private market assets to a broader investor base is kind of some areas, some sectors, and niches within sectors are really only accessible through private markets. And is that your view? Is that the case, do you think, with AI and deep tech and some of the advances in data? Can these be accessed in the public markets, either directly or perhaps obliquely because a large corporate is involved, or are they really kind of only available in private markets?
Yeah, I think these opportunities, I mean, currently they're certainly only available in the private markets. That's why firms like yourself exist, Luke, to help hopefully democratize and open up the private markets to other investors, not just institutional investors. Because I think there is room for that, as long as you're obviously qualified to make those type of investments. On the incorporation of AI to our lives, I would say many of us are seeing that, even on the investment side. Just speaking from personal experience, my peers and I, there are those of us who actually help or have our due diligence process be augmented by some form of artificial intelligence or machine learning to perhaps take away some of the biases as humans when we examine deals. And I would say, the use of that is going to be further incorporated into all of our lives in the coming years, especially when we begin to see the power of something like, open GPT and the type of changes that it can have and create for others.
Gabriella, I want to bring you into this conversation and bring in private credit. We've been talking about this at DOT for a while now. When interest rates are on the rise, the benefits of getting into floating rate credit, which is not that easily accessible in the public markets, but is kind of a mainstay of private lending. Real estate loans tend to be floating rate. A lot of consumer loans tend to be tied to floating rates, and they kind of insulate you from rate increases, perhaps with a bit of a lag, but they're a bit of an insulator. We've seen a significant increase in interest from the institutional world over the last, probably the better part of a decade, but a real push in the last several years. That the volumes being pushed into private credit world. In this environment where you mentioned your worry, your expectation even that we could see an uptick in defaults, what does that mean for private credit generally? Like, is that an environment, should we be wary of the private lending sector because defaults are rising? And is there a good place to be investing when you think about increases in defaults?
Yes, thank you, Luke, for the question. I am fortunate enough to be able to spend my entire career in private credit, and I have seen the volume of private credit really from 0 to 1 to 3 trillions as it stands for the current market. So private credit as such, as an investment asset class, existed already for mutual funds in the US. And if you think about it, it's if you want to put your pension, you want to have a sort of natural hedge against rising rates. So it's totally natural that you want to have some protection. And that's why leveraged loans were considered as very important asset class in the US. Now, what happened in Europe, institutional investors discovered private credit because of the floating rate nature, because of the defensive nature, and frankly, if you want to have exposure to ESG-related assets, then this is really the best place to be. The whole SME market represents a major opportunity for change in the energy transition and the ESG transition. And if you're a private individual, what do you do with your money? How do you want to have protection against rising rates? So many people, what they have done is they have invested in real estate, but real estates are super illiquid, and you need to get it right. So what people did is they ensured that they invest in crowdfunding platforms, peer-to-peer lending platforms, or invested in private market fund assets lately. So there was a massive change and demand from private investors to invest in private market solutions. And I think it's good. It's very relevant because it will protect against rising rates. But of course, you have to be mindful about defaults. So what I would be very cautious about is what is the type of investments and where people invest in. We have to be mindful about counterparty risk. That making sure that people have alignment of interest. So I very much like platforms where you invest together with the managers, because there are some platforms where you have no alignment of interest. And the diversification I mentioned. So I think it's important to diversify between regions. It's important to diversify between managers and asset classes. So the private market universe is huge in credit. You can invest, you can select your time horizon, the geography, the currency you invest in. So it provides a fantastic opportunity for investors to ask the question, where do you want to become in 5 years' time? What is the liquidity I want to achieve? And so on and so on.
Thank you, Gabrielle. You mentioned crowdfunding platforms, the need to be well diversified, to be professionally managed. These are all things that have been on my mind periodically over the last several years. I never personally did any crowdfunded lending, but I had a colleague who sat next to me who did. There was much hype around those sorts of platforms. If we think back 10 years or so, I think the experience that investors had dabbling in direct lending themselves, the investments were curated in inverted commas by these platforms. It would appear from experience that they weren't as selective as they needed to be. Investors perhaps didn't diversify adequately enough in investing across these platforms, made investment decisions based around the yield, didn't give enough thought to the risks, and a lot of the borrowers on these platforms were not of the highest credit quality. And I think the risks associated with doing that yourself from a platform were underestimated, and the experience hasn't been great.
Yes.
Which is it looked like maybe the lending landscape was poised for a change a decade ago. But I think the experience of investors has probably slowed down if that's progress, it's slowed down that progress. And for me, the better place, and this is a bit self-serving, but for me, the better place to be looking at private credit, which is an enormous opportunity, which does provide areas of investment that aren't accessible in public markets. But the best way to do that is to entrust your capital with a patient expert manager whose interests are aligned with yours. They invest in the same debt instruments, either through the fund or directly. They're aligned through the way that they're compensated, and they can be patient. And that's a theme that perhaps we'll come back to in terms of the best vintage years historically in private markets have been those in crisis eras. To use Lance's quote on Warren Buffett, be greedy when others are fearful, right? There's the old saying that fortune favors the brave. And I wrote about that, and that was a title of one of my dispatches 7 months ago now, in June of last year. When other people are afraid to invest, that's when there's an absence of buyers. There's likely to be a surplus of sellers, and that's when you get great entry points. But if you're not a professional, it's very difficult to value investments in those environments, because what's called price discovery is best when there's lots of willing buyers and lots of willing sellers. And when you've got a disconnect between the selling and the buying communities, it's hard to determine what value is. And for me, when you make a commitment to a private market fund, you're not timing the market. What you're doing is making a decision to entrust your capital with a well-aligned expert in their field, who will then use the next 6, 12, 36 months to find investments of value and where they can be impactful in terms of helping a business grow and maximizing return for their investors. So this is a difficult market to time. But when you commit to a private market fund, you're not timing the market. You're simply making a decision to entrust your money with an expert.
No, absolutely. I would like to add maybe 1 or 2 more points to that. Private credit managers most of the time grant credit up to 50% loan to value. And it's very much a bilateral relationship. So what does it do to you as an investor? If things go wrong, you make a debt equity swap. So you protect your downside. But in addition to having a return, you also diversify. So if you look at the coupon paying elements of a private credit, you get a coupon plus some sort of warrants, rolled up interest. So it can be pretty attractive. It can be up to 10, 15% interest very often for growth companies. And these companies are very often financing companies in the EI sector, energy sector. So the financing of the growth economies in a more protective way than private equity does. So I would really look into it as an investor, how I could create a diversified, relevant portfolio in current times.
Thank you. I want to, speaking of relevancy, and a theme that a couple of you actually mentioned, climate change. I didn't have enough word space in my Outlook paper to go beyond 3 key themes, but one that certainly is not going away, probably never will go away, is the need for accelerating the energy transition, for particularly in Europe, energy security. In the past decade, the US has talked a lot about energy self-sufficiency. That's not so much about their security as a country, but about economic independence, not being reliant on foreign countries for energy supplies. In Europe, this is very close to home, energy security, and the war in Ukraine has really brought that to the forefront. We became far too dependent on Russia over the last 20 years for oil and gas supplies, and we need to break away from that. That's not going away. Here at DOT, we partnered with Actis in their Energy 5 product a year ago. We closed on that vehicle, and they are ramping up investments, just by way of example, ramping up investments in renewable energy in Eastern Europe, because there's a significant demand that is just accelerated. Not to dwell on that, but Lance, you mentioned climate. Nat, you've mentioned it. Gabriella, you've all mentioned it. Where are we likely to see some of, and invite anyone to jump in with this, but where are we likely to see come some of the, I guess, best opportunities in climate transition? Because that's a big word, actually, climate, a big term, climate transition, which is anywhere from renewable energy through to some more the technology side. Where might we see those opportunities coming through?
Maybe I'll jump in here, and I think the broader point actually isn't just the climate change question and energy security. It's just security in general, I think, is an underlying trend where there's both challenges and opportunities. So interesting, the point about the defaults on the credit side. I agree that there will be some, but if you look at Japan, and you talked about the 20 plus years, a lot of that got absorbed by the government incentivizing private savers to bail out the economy all these decades. And so whilst there will be defaults, you can see in different countries, even in the UK, the government has told the banks to give great forbearance, for example, to mortgage holders. So we're going to see, I think, quite a lot of zombie activity, quite a lot of socialization of debt and dysfunctional economic activity. But there will also be volatility in geopolitics. Climates will continue to do that. So how do you deal with that? On the one hand, you're going to have in certain countries higher taxes because the government is shock absorbing everything. And then as private investors, one of the thoughts I had is in this environment, I think it's Taleb who wrote a book, Anti-Fragile. I'm always very interested in what things thrive when things get tough. In fact, what gets stronger when things get tough, right? And so I think in this environment, it would be good for investors to find managers who have an angle, which is to invest in relatively safe things, commodities, real estate, whatever, but where if there is a spike because of some volatile situation or a massive set of subsidies by government to back an industry to solve a problem, that you could benefit. I've often been interested, for example, in real estate by motorways, by freeways, which generally is lower price because there's pollution, right? But of course, as we shift to electrification or alternative forms of greener transport, what does that do to the price of it's a long-term play, but again, you see that example. If there's a massive push to, for example, in London, they've brought in, they're bringing in pricing to tax the cars that are dirty, right? These kinds of actions, they're hard to predict, so you have to diversify. I'm very interested in the climate space in biochar right now, which happens to also be really good semi-replacement for fertilizer. And given the ongoing war, you've got a shortage of ammonia, phosphates and so on. As an alternative, it's great because it also is locking carbon away, right? Sequestration. Yeah. So I think cybersecurity is huge. Should there come a moment, God forbid, when internet encryption gets broken, you want to be behind the companies that have been working on solutions because they'll suddenly get a massive influx. So if you can find them for the right price, or if you can back managers that can find these companies at the right price, whatever size they are, but which stand to benefit, it'll be like owning Pfizer, a year or two or three before the first lockdown. You can't put all your eggs in that one basket. But if you assume that we're in a world that needs more anti-fragile solutions, then some of your bets are going to really do well, even in this environment.
Lance, without getting too close to any specific funds that you manage, which we can't really talk about in this forum, but what are you seeing this sort of investment, the type of investment that Nat's just been describing? Do you see opportunities like that in the secondary market that are climate or climate transition or related? The question of biochar and fertilizer replacements. Do you see opportunities like that in the secondary market, or are they a bit more mainstream stuff?
Yeah, it's a bit of everything. We see exotic things that Nat mentioned. We see traditional renewable infrastructure developers out there, even on the private credit side that Gabriella mentioned. I would also add, let's not forget software as well. I know we talk a lot about infrastructure and what it does for renewables, and obviously there's going to be trillion and it needs to be spent, but you kind of need software to power some of that. And to Nat's point on security overall, Look, cybersecurity is a growing crime out there that I don't think the layman really recognize the type of damage it could do. At the advent of Russia's invasion in Ukraine, it was widely speculated in the press that there's been a number of blackouts that happened throughout Europe, in the UK even, in anticipation of the war and of the conflict. We all need to be aware of that and reticent of that. And there's been a lot of software developers out there, startups in the venture world, that have put forth product offerings to combat that. And I would see that as another huge growing theme within the overall, sort of the climate impact that I would say probably not talked about as much, but it's just as crucial in ensuring security for all.
Yeah.
Gabriella, please.
Yeah, I would very much echo that. You asked what sort of opportunities will there be out there. I mean, there are two things here. One is the reduction of energy dependency on Russia because of the war. And the second, which is a bigger theme, is how are we going to make sure that we stop the global warming? Yeah. And these are related themes, but not entirely the same. I do feel that there will be huge opportunities in carbon emission, carbon capturing, waste management, replacement of certain materials, like leather, how you do this transition. In the entire value chain, huge opportunities that will be funded by venture capital, venture debt, and they will be growing companies. So we mentioned about predictability. Life cycle of companies are reducing. So we will have a lot of interesting companies appearing, and it would be very pity to miss this wave because most of these investments happen in private markets. And I do feel, I'm coming from the Netherlands. If you look at how many listed companies we had 20 years ago and how many we have today, 75% reduced. So not a lot of companies want to be public. Many companies want to remain private.
Yeah, we've experienced that in the UK. That's the same trends have taken place in the US. Managers find it easier to manage and grow their companies outside of the public glare. And when there's been ample funding available in private markets, they've been able to stay private for longer. There's been a lot of take private activity over the years as larger and larger funds are raised in the private markets world. So it's taken some very interesting high growth companies out of the public sphere. And so even index funds have changed composition over time as buyout activity has accelerated in certain sectors. We got about 5 minutes left. Please, anyone who's listening, if you have a question, either a general question for anyone or a specific question for Nat, Gabriella, or Lance, please fire it through in the chat function and we'll try to get that addressed. A lot of ideas have been thrown out in the last 55 minutes. I want to ask each of you in turn to give us your very best idea amongst all those that have been thrown out and discussed just now. If you had one investment to make in 2023, what would that be and why? And you've got 90 seconds for an answer. Lance, I'm going to go over to you first because you look the most prepared.
Oh, stop it, Luke. Look, secondaries, and I'm fully aware that I'm certainly very biased given the space I
You're talking your own book.
I am in a bit. I think we're seeing massive supply out there of secondary opportunities and everything we just discussed in the past hour. But the demand is not necessarily there. And when I say demand, I'm talking about capital overhang. We're looking at sort of in terms of a ratio, we take supply divided by capital overhang. It's been the lowest and probably in about a decade since the GFC. And as we all know, if you're an investor and you have capital to deploy and you're bold in times like this, there's a lot of good opportunities to be had. It's a ripe environment, and there's going to be less competition. So the vintages that's going to come out for 2023, 2024 even are going to be tremendous vintages that's probably going to rival some of the amazing returns, top quartile, top decile returns that we've seen since the GFC.
Agreed. Thank you for keeping that short and sweet. Gabriella, best idea for 2023, okay. 90 seconds.
Well, for me, I think the most important question is what is the legacy I want to leave behind? Because achieving return is one thing, but I think we have to leave a livable place to our children, and we need to start investing today in order to make sure that we have a livable place, because there is no business, no living otherwise. So I would invest in a responsible investor that are in line with my values in investing in energy transition. And I would invest in the junior credit space. So similar to what I mentioned is that, I want to have some equity cushion, like 40-50%, and coupon paying equity. So combining return with impact and in line with my values.
Excellent. Thank you. Nat, last but certainly not least, one investment for 2023 and why? 90 seconds. You're on the hot seat.
I'd actually be working with managers to invest in older businesses, but with cash. So, like your mining, your oil and gas, some of your corporates, but where they would bring in these technologies, the generative AI, what's left of Web3, but particularly for learning, HR and education, and then carbon sequestration to affect the energy transition. So people who've got cash but need the new tech to help solve some of the problems that we face in the short term. I feel like that's a really good marriage at this time. Yeah. Excellent.
Thank you. I think that I've actually had some interesting conversations around that very theme, Nat. They may or may not be represented on our platform in the near future, but some interesting discussions around that. And there's different thoughts on how to be most impactful with your money. I think it's probably a shrinking pool of people that want to outright exclude certain investments from their portfolio, and others who want to invest, as you mentioned, heaven forbid, hydrocarbon producers, fossil fuel producers, miners. They're producing essential, economic fuel, if you will, literally and figuratively. We need them. We're going to need them as part of the transition. Perhaps the best way for us to invest is to help them become greener, more responsible, improve productivity, and the application of new technologies, as you've highlighted earlier, are probably the best way that we can facilitate that transition. They're not going away. We need to find a better way to work with them going forward. As we've kind of hit the limit, we could carry on talking. I'm enjoying this. We could probably carry on for another hour, but we've budgeted an hour for this. Just to summarize, I think here at DOT, we're excited about the secondary market opportunities, which are broad. We've touched on a couple of the themes within secondaries, which might be most interesting, most productive. We're excited that this could be some of the best vintage years in private market space. My own experience of this, I worked for the UK's largest pension scheme during the GFC, and we were just rolling out a private markets investment program when the GFC took hold. And to the great credit of the trustees and the investment team there, we stayed the course. I think it was probably a bit nerve-wracking, some white knuckle moments allocating capital in the throes of the GFC, but those turned out to be some hugely profitable investments, some pretty unique entry points to invest in great companies. And as worrisome as the market environment might be for many, that kind of represents a once a decade, if not once in a lifetime opportunity to enter some of these markets. So we're really excited about what we're seeing in the secondary space and in private credit. As institutions have done over the past decade, it's very often a pretty unique way to diversify your existing investments, whether they're public or they're private. Private credit has some pretty unique dimensions in terms of term, risk, floating rate versus fixed rate. The terms, it's a complicated space, but it's because of that, it's right. It's got some great opportunities that are presented to investors. And I think it's something that a lot of people should be considering as both a diversifier for their portfolio, but also to increase return relative to what is available in the public market space, the listed space, and technology. Now, you've touched on some pretty interesting themes in the technology space as it relates to climate change, and these are areas that we are close to our hearts here at DOT. One of our underlying themes is to enable investors to align their investment activities with their values. To that end, we look for investments in the climate space. We look for investments where not just our managers, but the investment dollars directly are impactful in the communities in which people invest. And hopefully we'll be bringing more of those investment opportunities to the platform this year. For our listeners, thank you for your time and attention. Please visit our website, take a look at what we're doing, sign up to get access to full information on the products that we offer, and come and have a chat to us. Finally, thank you to all three of you for giving us your time today. A little bit over time now. I want to give that back to you. Nat, thank you very much. I know how busy you are. It's difficult to get time with you, and you've made yourself available today. Really, thank you very much for that. Gabriella, same. You're not even at home. You're away speaking to us from a hotel room. So thank you very much for finding the time for us today and sharing your unique insights in private credit and from a seat in Eastern Europe. Lance, thank you. Really appreciate your insights coming from the States. It's a very different perspective to what we often hear and see here in Europe. So thank you very much for taking the time out this morning. It's early for you in New York City. So thank you very much for making yourself available. I know you've got a busy day ahead. Thank you very much, everybody. Much appreciated.
Thank you, Luke. Thanks for the organizers. Thank you. Bye-bye.
Bye.